Artificial intelligence and data centers are increasing energy demand. So, should you be investing in natural gas or oil or clean energy? And how about earning an income? Are you at all worried about paper losses? Should you be? All this and more in my free video conference and podcast. Remember, you can invite your friends to watch it, youtube.com/Natalie Pace and Natalie Pace on Substack as well. We'll get started in just a moment. Okay, so here we go. And again, this is on oil, natural gas, and clean energy. And of course, that rising demand for energy that's coming largely from the big $4 trillion AI companies. And we will be talking about that in a moment. So again, right now, oil is at 62 and 50 cents a barrel. This is below the profit point for new drilling. So even though you see drill baby drill, oil companies are not predicted to drill baby drill when prices are so low because they can't profitably do that. And we're also seeing that in the survey of executives themselves. So this is a survey that is done by the Dallas Fed. And when he asks a special question, like how many of your firms expect to drill in 2025, has this changed? And so a lot of people say that they have decreased either significantly or slightly the amount of drilling that they expect to do this year. There are a lot of other very important, survey questions there, including water management issues, particularly in the Permian Basin. So you do want to be aware of that. But the overriding thing that we want to be aware of right now is that low gas, oil and oil prices, we'll talk about natural gas in just a moment, this actually can make companies report lower revenue year over year, right? So we're seeing that a lot in BP, Chevron, ExxonMobil, Cenovus, that because the price point of your product is less, that means fewer dollars that are coming to you. And that's not great either. So in addition to less drilling, you also have lower revenues. Now, the EIA is actually, this is the U.S. Energy Information Administration, is forecasting that oil prices will go down in the fourth quarter of this year and in even further in 2026. And this is due to increased production from OPEC, reduced global demand, especially from China. We'll talk a little bit more about that. And also concerns about the global economy. There's also a reduced war risk premium because of the ceasefire. So again, before we jump into that, I want to just say that, there could be a shock that would send prices either direction, right? In the pandemic, that was a shock that actually plunged the oil prices to a negative. Like people, the futures traders were having to sell for a loss in order not to have to take possession of all this oil that they were going to have to take possession of. On the other hand, a major outbreak of war increases the demand for oil, and that pushes prices up. So the all-time high for prices was at the height of when the US was fighting two wars in Iraq and in Afghanistan. So these are projections, but there can be shocks that would make things different. Now, conversely, natural gas prices are projected to increase. So they are expected to increase to $4.30 MMBTU in 2026 and $5.40 by December of 2026. So that's a lot higher than it is right now. But the challenge is that the oil companies are the ones that are typically producing LNG and natural gas. So over that same period, if you have oil prices, which is their main revenue generator, at a much lower price, but you have LNG and natural gas prices that are a higher price, it could end up being a wash rather than being a boom. So this is kind of important. Of course, you can find some natural, maybe smaller natural gas, especially if they're just doing the pipelines or something like that, that might be benefiting, and that could be of interest to you. Now, I also want to talk about high yield energy stocks because a lot of times we're getting sold into these things for the income, and they're saying, do not worry about the price going down because when the price goes down, the yield goes up. And that is true. But what they're not saying is that when the price goes down, there's usually a good reason for it. And if the yield goes really high and the price has dropped significantly, and the reasons that people are worried come to fruition, then they'll have to cut the dividend, and then the price plunges further. It's a gap down overnight. You can't do anything about it. And it could end up in having to declare bankruptcy. And then, of course, your stock gets completely wiped out if you happen to invest in a dividend paying stock. If it's a bond, then you're going to take a haircut on your principal. And sometimes you lose all the principal and they just turn it into stock in the new company going forward. And you better hope and pray that that one does better. So this is a very high risk. The higher the dividend, the higher the risk. And we're seeing a lot of this. There's low trading volume. So even if you think you are able to say, okay, I see the risk, I'm going to trade, there may not be a buyer on the other side because the volume is very low in these high income producing stocks anyway. Also, very low trading volume in long-term bonds as well. Sometimes it's difficult to find the financials. They might have most older companies in the oil and gas industry have very high debt. Many are at the lowest rung of investment grade. Again, some might have exposure to water issues, particularly in the Permian Basin. So you want to be familiar with that Dallas Fed survey. They do it quarterly, and these are of the oil and gas executives themselves. And remember that investors are forward thinking. So if you are not, by the time it hits the headlines, it's too late to respond. Now, this is one example. This is mock natural resources. Investors got very concerned with it. Obviously, they started selling the stock, and the 1 year return on the stock is actually lower. So it wiped out any kind of yield you had hoped to earn. And then again, you can't really see a lot of the other information, including what are they charging you for this fund, for this particular stock or fund. So it's really hard to find information on these. Here's that lower volume. Like if you're trading NVIDIA or the Magnificent Seven, there's millions of buyers on the other side. There's just not as many in these. So remember that paper losses can become real and substantial. There were over 100 oil and gas bankruptcy in 2020. Many of the older corporations are carrying very high debt, very low credit quality. And remember, we didn't even know we were in a pandemic until March of 2020. And these companies almost immediately had to declare bankruptcy within, that same year. And that's because of the high debt and the low credit quality going in before the shock happens. And that's still the case today. So energy, not surprisingly, is one of the lowest performing sectors year to date. It's only 3.6% total return. That's including all those dividends that you're hoping to earn. And that's as opposed to information technology, which is, what is that? Almost five times the communications services. That one is even higher, right? So this is important. And one of the things I wanted to show you about that is that you should have a diversified plan. If you are going to have income producing oil and gas, maybe it's a large cap value fund, right? Not your whole game because you do want to have performance. Listen, as I showed you on this chart, the performance of the top four, I'm calling them the Fantastic Four, they're responsible for a great deal of returns in the S&P 500. So if you don't have large cap growth, you're not even performing at the S&P 500, right? You could be performing a lot lower. And if it's all in income producing oil and gas, then it could be one of the lowest performers at less than 4% this year, and that's including the stock performance and the yield. So again, you want to make sure that you have large cap, mid cap, small cap, value and growth and HOTS, right? And we're going to talk about what could be in the HOTS in just a moment. If you want something that's income producing as a hot slice, that's okay too. But it's probably not that hot if it's only earning 4% total return. So, which countries will be hot? And the reason I mention this is that in our pie chart sample, you'll see we have replacements for our values. And the reason is that there are other countries, many of which give you a higher income and some of which are even higher credit quality, and many are actually lower debt to GDP. So that's what we're using. And by the way, some of those have been super performers for us. So one of them was a Peruvian ETF, and that one has been performing on par with the Magnificent Seven, largely because it's the second largest exporter of copper in the world, and copper prices are high. So let's move into clean energy. And this is the sources of US electricity generation in 2023. Renewables were about 21.4%. They're now about 24%, and they are increasing. And that's up from 14% about 9 years ago. So AI and data centers are increasing energy demand, but the big four AI companies want it to be clean. So they all have very ambitious goals of having their energy produced by non-carbon polluting generation facilities. Now, Microsoft's going to lean into nuclear, but the other companies, NVIDIA, Google, and the other AI companies that are in their Meta, for a large part of them, they are leaning into solar, some wind. So let's take a look at that. And again, this information is provided by the Energy Information Administration. So solar is expected to lead the US new generating capacity in 2025 and 2026, followed by battery storage. So 26 gigawatts of new solar in 2025, 22 gigawatts in 2026. Now, the problem is that many clean energy companies have struggled with high debt and cash negative operations, and some have declared bankruptcy. So these are some of the bankruptcies that we have seen over the past 2 years. And what I would say to you is that I would not invest in individual companies unless you're able to pick stocks like Warren Buffett. A better idea would be a fund. And the clean energy funds, those fund providers are looking for, especially the Global Clean Energy Fund offered by iShares, ICLN, they're looking for global operators of clean energy. And, if you're investing in a fund that has 50 companies and one goes bankrupt, you still have 49 companies that are doing good, and that reduces the risk for you. So another thing to remember is that you want to, again, we talked about diversifying, right? So you could have clean energy as a hot slice. Whenever you want to go for one industry, it's a hot slice because these other funds are diversified in many different sectors. Um, but you also need to be rebalancing it once, twice, or three times a year. And the Clean Energy Fund is the perfect example of this. Because in the pandemic, clean energy, ICLN, dropped to about $11 a share. And that was in March of 2020. By January 2021, it was $33. So if you had one hot slice, that became three hot slices. And if you're rebalancing once, twice, or three times a year, you see you have three slices, it's begging you to sell high and trim it back to one. And that increases your wealth and it provides liquidity so that if that price then goes down again, you can buy more at a lower price, right? So this is a buy low, sell high system on autopilot that takes the emotions out of it. Now, the interesting thing is that we see that clean energy is now trading at a very low price. It's down 50% from its January 2021 highs. Nobody wants to buy low, right? So if you're actually using the pie chart system and your slice is small, maybe you'll be one of the few people that would like to buy low. So here it was at 33. You can now buy it at 14. A lot of people, when they were reading the headlines on clean energy in January of 2021, wanted to buy it then. Now, when you're seeing, oh, well, they stripped, and they did, by the way. The tax credit for electric vehicles is gone at the end of September. The tax credit for businesses and homeowners for solar and wind is gone at the end of the year. The Energy Information Administration is factoring all of those things in. And the reason why solar is expected to increase is because of the demand for AI and data centers, which is from the Magnificent Seven. I call them the Fantastic Four. You'll see why in just a moment. And yeah, so they are wanting clean energy. So that's where the big demand for new generation is coming from, and they want it to be clean. So it could be, I'm not saying it is, but it could be, you could make a case for buying low in that clean energy ETF, but not necessarily in individual companies. So let's talk a little bit about EVs because electric vehicles are the fastest growing vertical over internal combustion engine. This reduces the demand for oil and gasoline a lot. And the demand in China for EVs is the most of the world. They buy more of electric vehicles than anywhere else in the world. But I would not invest in the iDrive, which is electric vehicles and autonomous vehicles ETF. And the reason for that is that EVs have many challenges. There are price wars. Higher unemployment mean fewer people buying cars. Consumer spending is getting more constrained. Same problem. High cost of materials, lower profits, price wars. So, as an example, Tesla's most recent revenue report was down 12%. Their net income is really down. 2024 was down by half over 2023. You can see the numbers there. And 2025 is looking even more challenging. So, should a company that's going to make maybe even less than 5 billion in 2025 net income be worth over $1 trillion? Tesla is valued at higher than GM, Ford, and Toyota Motors combined. So be very careful with investing in Tesla these days. That is no longer part of the Magnificent Seven. Is That's why I call it goes down to the Fantastic Four. And I'll go ahead and show you that slide. It's one of our earlier ones in the performance slide. There we go. So you can see here that Tesla is way down, but it's also down because the sales and net income is way down. So the Fantastic Four, NVIDIA, Microsoft, Meta, and Google. So be careful with individual companies, even ones you really love. A lot of people do like Tesla still. Also, a lot of people will say, oh, well, I'm investing down the future because Tesla is actually an AI company. And yes, Tesla definitely is into robotics and AI and even solar, right? They have a lot of things down the pike, but they could be down the pike. And could there be lower stock prices before we get there, right? So that's a lot of things that you want to be thinking about. Again, the fund kind of smooths out that volatility. But before you buy into, okay, Tesla versus as an AI company, I think you should be reading up more about Tesla Vision versus LiDAR. And you should be sure to read my blog and watch a former NASA engineer do a side-by-side entertaining comparison between the two. So I do have a blog on Tesla Vision versus LiDAR. Just email info@nataliepace.com and ask for a link to that blog, or go to nataliepace.com/blog and search for LiDAR or Tesla Vision, and you should be able to find it. So again, oil, gas, clean energy is a bit tricky. Oil and gas and energy is the lowest performer. Clean energy has certainly not been a great performer this year. I would not be investing in individual companies. I might lean more into clean energy than oil and gas. If I was looking for income in my values, I would actually be doing value replacements where I might get a higher income and lower debt to GDP and sometimes even higher credit quality. And those are all things that we teach at our Financial Freedom Retreat or in my private coaching. So go to nataliepace.com and check out the Financial Freedom Retreat. The next one, which is the last one that we're going to have this year, is going to be in October. And after the retreat, the Saturday afterwards, we're going to have a fixed income without paper losses masterclass. So you can get pricing and information. And just FYI, inflation has put most prices sky high. We've actually been able to lower our costs because we now can conduct our training online. So it's easier for you. You can do it in the comfort of your living room, no travel or lodging, and we lowered the price. You can bring a second person for half off, and you can bring a teen or a college student for 199. And why not give a teen or college student the ABCs of money, the life math that we all should have received in high school? So again, our fixed income strategies since the Great Recession have not had paper losses. And many times you're going to be earning double the yield. So I'm going to show you a little bit more about that. So remember, you want a 21st century time-proven plan, age appropriate, properly diversified. You can actually personalize your own sample pie chart through our free web apps. Simply go to, well, actually, email info@nataliepace.com with free web apps in the subject line. You can also take our investor IQ test and our rebalancing IQ test, and that's going to help you as well. If you would like once you know your sample, you need to know what you actually have. So if you might be interested in a holdings pie chart and an unbiased second opinion of your current wealth plan, email info@nataliepace.com for pricing and information through my private coaching program. That could be invaluable. Know what you own. You want to fix the roof while the sun is still shining because it is human nature to wait until something is broken to fix it. When it comes to your money, losing half of your wealth can be devastating. Your FICO score plunges. Your resources obviously plunge. You have no ability to buy low, and you might be scrambling. So now, with stocks high, is the perfect time to protect your wealth and make sure that you're properly diversified. So also, I do have new oil, clean energy, and electric vehicle stock report cards. So if you want a link, if you'd like those updated, I'm happy to send them to you. Just email info@nataliepace.com. If you would like the links to some of the different blogs that I'm talking about, I'm going to have them in the description on the YouTube channel, youtube.com/Natalie Pace. And you can always email us. Hey, I want to link to that LiDAR versus Tesla vision. I want to link to Natalie's oil blog. I want to link to Natalie's clean energy blog. And by the way, there is a new clean energy blog. If you just go to nataliepace.com/blog, you'll see that the top hit is going to be that clean energy blog. And then finally, there is our financial freedom retreat. We are hosting the Fixed Income Without Paper Losses Masterclass the Saturday after our retreat. This is the final training of the year. It's a great idea to do it now. And again, you can make up to double the yield, lower the risk, increase the protection. And we're proud that our strategies have no paper losses. You really need the retreat before you can attend the master class because you need that information in order to understand what I'm going to teach you in the master class. Of course, if you are an experienced trader or a financial services professional, then we can make an exception for you. But most people are really going to benefit attending the retreat before the master class. So again, thank you for joining me. Be sure to follow me on social media, on Substack, on YouTube, so that you are always sure to get notice whenever I post new video conferences and podcasts. I do daily money tips on social. So go to nataliepace.com, and on the homepage, you're going to see all my social. Excuse me. Facebook, X, Instagram, LinkedIn, email, podcast, YouTube. And thank you again for joining me. Be sure to share this with your friends. And again, be sure to subscribe on YouTube and Substack. And we look forward to providing you with the news, information, education you need to be the boss of your money. We've been transforming lives on Main Street, adding a splash of green to Wall Street since 1999, enthusiastically recommended by Nobel Prize winning economist Gary Becker, former chairman and CEO of TD Ameritrade, Joe Moglia, and over 120,000 people who've either downloaded our books or attended our retreats or had my private coaching and transformed their lives. Thanks again, Natalie Pace, and thank you for joining me.